In today's video, I want to start off with the COT reports, because that seems to be the latest crutch that the bears are using as an excuse for why gold is going to turn back down and re-enter its bear market. So I'll start off with that. Now, again, let me say, for the umpteenth time that baby bulls are different than any other market. You cannot use the same tools that you used during a bear market, and that's what I see happening with many analysts. It's either gold is in a parabola and it's going to collapse, which is ridiculous. Parabolas form at the top of bear markets or bull markets, not at the bottom of bear markets. Or the latest is that the COT reports are bearish, and that means that gold is going to top and head back down and go under 1,000. So let me cover that first. So first off, you can see here I've got the total net position in the commercials calculated right here, along with the Blees rating, and I've gone over this before. It's the calculation of to what degree the commercial traders are net long or net short. A Blees rating of 100 is the most bullish, and a Blees rating of 0 is the most bearish. So just based on the Blees rating, gold is just a little bit below neutral. So we aren't terribly bearish yet. The total commercial short position is only at 259,000 contracts. At previous tops, the total commercial net short or total commercial short position has been over 300,000, even as high as 340, 350,000. So we've still got plenty of room here before the COT becomes bearish. Now, let me show you what happens when a new bull market begins. When a bull market begins, the commercials don't typically recognize the turn. They're like everybody else. They're slow to understand that the market has changed. And so what happens as price rises, the COT report becomes more and more bearish. The commercials add to their short positions until they reach a bearish extreme. So you can see right here, the COTs reached a maximum bearish Blees rating of 0. This was as gold was coming out of that bottom in 2008 and into 2009. And you can see what happened. Price rose up to that $1,000 level. Commercials got very bearish, and then they just maintained this bearish level week after week after week as price kept going up and up and up, until finally the commercials had to start covering their short position into higher prices. So if a new bull market has begun, a bearish COT level is not necessarily going to mean that gold is going to turn back down. It could mean that the COT will just remain bearish for many weeks as the commercial traders finally recognize and accept that the market has turned and that they've got to change their trading tactics. And I'm going to suggest that traders need to do this. The things that worked during the bear market are no longer going to work anymore. You have to throw those tools away. You have to start fresh and view the market in the context of a new bull beginning, rather than trying to stay stuck in this bear market mentality, expecting the things that worked during the bear market to continue to work, because they just won't work anymore. You have to use different tools. Next, I'm going to look at the mining stocks, at the HUI index. Now, we've seen traders and analysts, continue to try and pick a top in this sector for weeks now. Every push higher is an excuse to call a top, and the market just continues to run away from them. And I'm going to suggest that what is happening is that we had a very extreme move down right here into this bottom from last May to this bottom. Then we had a multi-month consolidation. We had a classic undercut bottom, and now the market is just reacting to the upside to this downward move. So it is mirroring this move down on the upside. So I'm going to suggest that we probably aren't going to see a top to this move until we get up and test that April-May high. And so for those of you that were able to change your mindset and adapt quickly to this market, you have ridden a huge move up already. The market is up 65% in about a month. This is, and I've said this over and over, and this is why I was willing to try and call bottoms in the metals market, because I knew this was going to happen. And I'll say this again. This was an artificial bear market. It was manufactured by the bullion banks taking control of the paper markets. The position limit laws were not enforced, so they were able to drive gold artificially down. And I said over and over that when the manipulation breaks, we're going to see a different kind of bear market ending. A normal bear market would just it would just do this. It would just trade sideways, chop around for months and months and probably years before finally slowly starting to grind higher. Over many months or even a couple of years. But I told you, a long time ago that was not how this bear market was going to end, because this was not a natural bear market. This was an artificial bear market, and it would end when the manipulation was broken. And that is clearly what is happening. And I said that we would get a very explosive rocket launch type ending to this bear market, because it would end with the market breaking the manipulation. And you can see that is exactly what is happening. Not only in miners, obviously, but also in gold. Once this bottom was put in and the manipulation was broken, gold has just literally exploded higher out of that bottom. It's gone straight up. And again, this is not a parabolic structure. This is a market bottom, not a market top. And this is a market that is breaking 4 years of manipulation. So don't expect this to act like any other market. Baby bulls, and especially baby bulls that are angry from 4 years of manipulation, are not going to behave like any other market in the world. You can see that this market has just sliced right through two major resistance zones. We got the intermediate top in October and the intermediate top back here in May of last year. And I suspect before this intermediate rally is over, we are also going to take out the yearly cycle high of 2015, which is a little above, I think it was 1307. I expect we're going to take that out also. So in closing here, let me repeat again that the way that big money is made is you have to recognize these big trend changes. You have to recognize them quickly. You have to adapt to them quickly. You have to break the bear market mindset that most people have been in for 4 years, and you need to accept that the market has changed and then reverse directions. The analysts, I've said this again many times, the analysts that rode this bear market down correctly are not going to be the analysts that you want to listen to call a bottom. They're going to expect the bear market to continue. That's how they made their name, by calling the bear market and by riding the bear market. and they're not going to be able to change gears. You need a different type of analyst, somebody that is more flexible and that can adapt to changing conditions. The sooner you can do that, the sooner you can get on board and start making money. This was a once in at least a decade opportunity to get on board at the very beginning of a bull market and make incredible gains incredibly quickly. Almost everybody has missed this, so you've already missed the initial rocket launch, but I'm going to say that this isn't done yet. I think we still have to go up and finish this mirror move and get back up to this summer highs around 180 to 190 before this initial push off the bottom is going to be done. And then at that point, I would expect we would have some kind of a multi-week handle for this obvious cup pattern, a multi-week handle that would trade sideways to down and correct this big aggressive move, and then that will set up the next leg of the bull market, which I would expect could be every bit as powerful as this, and probably take the mining stocks back up to this 2014 high around maybe 250 or so.